Hi, SAICA APC Candidate again. In preparation of the SAICA 2025 November or December exam, we are going to be looking at the Assessment of Professional Competence November 2019. We are still looking at the pre-release information, and the company that we are going to be using is SAICA Property Group Pty Ltd. So the company, just to give you a background, it is into the investment property. So they buy property and then they lease out those property to the retailing company. So in short, they are the landlords. So they are a landlord, and then they lease out the properties to the tenants, and the tenants will be the shops like your Checkers, your Perp, and all other shops that are leasing to them. In the previous class, on the class 1 of November 2019 APC, our main focus was basically on document A. And in the document A, I took you through everything that is important for you to understand about SAICA's property group. Now, our main focus will be on the document B, C, D, and E. So we'll go in details into document B, and document B will be covering the SAICA. And then when you're looking at document C, it is about the audit presentation. Document D, we are going to be looking at the valuation. And then document E, we are going to be looking at Hope for Children Trust, etc. So what is important for you to see here? When you're looking at the SAICA, you don't know exactly what head you need to bring on. Is it accounting? Is it tax? Is it management accounting? Or it is auditing? However, when you're looking at audit preparation, now you can tell by now that you might need to bring in your auditing knowledge. It might happen that, unfortunately, you are not doing your article in the audit firm. In this case, your peers who are with you in your group or in your CASA journey will be helping you to guide you in terms of what are the kind of things that you should take into account when doing C. And then when looking at D, it is valuation. Again, when you're looking at valuation now, it's coming to you that, now you need to think of management accounting and financial management because they are talking about valuation. And then when you're looking at E, it's Hope for the Children Trust. You don't know what will be the question. Do you need to bring your auditing hat? Do you need to bring your accounting hat? Or rather, do you need to bring your MANEC and financial management hat? Now, stay tuned and listen to me as I take you through document B, C, D, and E. Our first document will be document B. Document B is an email from the Chief Financial Officer to a newly qualified CASA. A newly qualified CASA, in this case, it is the candidate, is the person writing the paper, or rather, it's a person that was writing this paper in the year 2019. So this email obviously is coming from Yvonne Jege, and we know Yvonne Jege in this has succeeded Yvonne Jege, and we know Yvonne Jege is the CEO of the company. Good morning. Let me get you up to speed with one of the problem tenants, Ziggy Beggars Ltd. The happenings there will keep you quite busy, and your accounting and tax expertise will be most helpful. Ziggy is a fast food chain listed on the Johannesburg Stock Exchange that is currently in business rescue. They are really giving us headaches, but we can't teach them. We are very important in the tenant mix of all shopping malls as they bring footfall. It will also be difficult to replace them. So now what do you see here? Now they are bringing the information about the Ziggy Beggar. So what is important to know is that they are listed on the Johannesburg Stock Exchange, meaning to say they used to do well in the past because in order to get a listing, there is a revenue requirement that is required of the company. So it might mean that they have been doing well in the past. However, they are now experiencing challenges because they are going through the business rescue. So now we ask ourselves, what would be the reason that the fast food company will be going through the business rescue in South Africa? There are a number of reasons. The competition is high, and also the economy might not be doing well. People are choosing to cook at home rather than to go buy the fast food. It might happen that as you see a lot of foreigners are having small shops for fast food, people prefer to buy from them as opposed to going to Ziggy Beggars. So there are a number of reasons that are making this company, Ziggy, to go through challenges. What the CFO is saying to you is that they are having headache from this company. However, they cannot just ditch them. And they have put the reason in front in terms of why they cannot just ditch Ziggy. And they're saying the reason they cannot just ditch Ziggy is because they are providing the tenant mix as well as bringing footfall. So what does it mean? So when people come to buy from Ziggy, they eventually go to other shops. And when you're looking at tenant mix, they are mixing the tenants. That means we're not only having now the tenants that are selling clothes, but we also have tenants that are selling fast food. So they are important for the company. In case you think of the solution is to teach them, just take in mind that there are advantages this company has to OCOS. And then they are saying also the other thing, it will be difficult to replace them. So there are a number of reasons that this company, regardless of giving headache to OCOS, will not just be ditched. And the reason they can't just ditch them, they are providing three valid reasons. And the first reason is them bringing the tenant mix and bringing footfall, as well as it will be hard to replace them. Now let us go down and understand why this company is giving OCOS a headache. Ziggy currently owes us 3.38 million in area rental fees. Our related accounting provision allowance for credit loss is 1.07 million, and the tax allowance for doubtful debts is 430k or 430,000. Our claim for the rental in areas was submitted and accepted by Finch and Masemola, the business rescue practitioner, who are handling the matter. The draft's business rescue plan is based on the following. Now, you now understand why this company is giving OCOS the headache. Why Ziggy is giving OCOS the headache. 3.38 million has not been paid by the tenant. Ziggy has not paid us or has not paid the OCOS 3.38 million of the rental fees. Already, 1.07 million has been provided as doubtful debt, and the allowance to SARS of 430,000 has also been claimed. Now they are saying they have submitted the claim, or rather, the company that you are employed by has submitted the claim to the business rescue practitioner, which is Fichi and Masemola. And then they provided the draft business rescue plan, and based on the following. Please take note, this is a draft business plan. Anything that is discussed here might change, or you might be provided different one option or all of them. So it depending on what is the final rescue plan. Now let's just look at this draft business rescue plan that is provided to OCOS and read it and see what the candidate was supposed to do during the pre-release period, during the 5 days period that was available based on the SAICA pre-release rule. So based on the plan, the option available is that swapping of the outstanding debt to new equity for new equity in Ziggy. Right. So, and then the crunch that was going to be provided to OCOS by Ziggy is crunch A. So what does that mean? It means that the 3.8 million is swapped to crunch A shares, right? A portion of it is swapped to crunch A shares. The second part of the plan, it's a reduction of 30% in a rental for the next 3 years in return of further equity crunch B. All right. And then when you're looking at 3, they said shares acquired under crunch A may be sold after 6 months, while crunch B shares can only be sold on the market in a 1/3 lot at the end of 12 months, 24 months, and 36 months. So crunch A, you can be able to sell them only after 6 months. However, crunch B, you can sell 1/3 after 12 months, 24 months, and 36 months. So now, what do you see that is part of rescue plan? You have two things that has been presented to you. Is that you're swapping the outstanding debt by crunch A shares, right? And you reduce the debt. If you reduce the debt by 30% in the next 3 years, you'll be provided other shares, which is called crunch B. And that then breaking down each of this share type and telling you how are you going to be able to sell the shares should you wish to sell them in future. So do you see the information that you have been provided? So in this information, it is very important, candidate, to understand that in the exam, they can swap it otherwise. However, what I want you to keep in mind as you read this is that you need to do an assessment of all the options available. Do the workings saying, if we swap the outstanding debt, what are the good things for us and what are the bad things for us and what are the accounting treatments and what are the tax treatments? So you're going to be looking at the qualitative aspect of swapping the outstanding debts to get the shares in ZIC. What are the qualitative aspects and what are the accounting and tax treatments? And number two, if we reduce the debt by 30%, right, for the next 3 years to receive further equity, which is classified as Crunch B. What are the qualitative expert? What are the accounting expert? And what are the tax expert? Then once you've covered the accounting expert and tax expert and qualitative expert, you need in your qualitative expert to consider that you are only going to be able to sell shares Crunch A after 6 months and Crunch B only 1/3 after 12, 24, and 36 months. In your qualitative expert candidate, you need to explain that you might not want to lose this company because why? They are providing tenant mix, they are bringing footfall, and it will be hard to replace them. So, in your qualitative expert, do not decide not to include the things that you have already been provided. Because how you're going to pass the SAICA paper is by bringing forward the things that have already been provided in the scenario. All your solutions in the exams are based on the information that you've already been provided in the scenario. You just need to articulate them and present it to the examiner in a way that makes sense, in the way that shows that you are adding value to the company. Because you are employed here as a newly qualified CSA, and as a newly qualified CSA, you are expected to add value to the company. And you can only add the value to the company by doing what? By taking the information that is presented to you and make it useful to the boss or to the company. Now let's then look what we have. The final meeting of the creditors to approve the business rescue plan is scheduled for Monday. I will let you know what comes out of that. So now you know that what we have been provided, it is the draft business rescue. And now the CFO is telling you, Guti, the creditor, the meeting to approve the rescue plan, the final schedule, it is on Monday. And the CFO will let you know of the outcomes. So now what does that mean? It means that by Monday, the CFO will know exactly what is the plan going forward. Are we taking this option? Are we taking this option plus this one? Or what are we doing? So that you will know by Monday. However, remember that you are sitting during your pre-release period. You need to understand the accounting treatment. You need to understand the qualitative expert. You need to understand the tax expert of this trigger. And then when you move down, I know that the tax implication of swapping debt for equity is complicated. I will therefore not expect of you to deal with Section 19 of the Income Tax Act. We are bringing a specialist for this expert if needed, or we can bring in a specialist for this expert if needed. So what do you see here? You are told that when you cover the tax expert of swapping the shares for equity, do not consider Section 19 of the Income Tax Act, because if the need arise, the specialist will be appointed for that matter. Now, let us summarize what you need to do for this trigger. So this is a trigger. With no doubt, this is a trigger, or this was a trigger because it was written in 2019. So what the candidate was expected to do in this trigger: number one, the candidate was expected to look at the tax treatment of both Tranche A and Tranche B, given the scenario of in Tranche A, it will be debt for new equity. And then in the Tranche B, it will be reduction of rental for 3 years. Under no circumstances would the candidates have went to the exam without understanding the accounting and the tax implication of this matter. And then what is the biggest point that the candidate needed to cover for this trigger? The candidate needed to cover the qualitative expert, where they're looking at the advantages and disadvantages of this entire transaction. What they need to consider number of things like the tenant mix, that they bring footfall. They cannot replace them. They are listed on JSE, so they have been with them for how long, So all those things needed to be considered, with the inclusion of it will take 6 months to sell Tranche A, and it will take 36 months to sell all of the Tranche B shares if the company wish to sell them in future. You need to take into account of things like, will we be able to sell the shares even after the period has passed, considering that they are going through the business rescue? Are the people willing to buy shares, or will the people be willing to buy the shares of the company going through the business rescue plan? So it is important, candidates, to understand that in the paper like this, the candidate was supposed to make sure they know clearly how to deal with this matter in the accounting side of it and the tax side of it, and what will be the qualitative expert arising from this transaction. So this takes us to the end of what the candidate was supposed to do with regard to the Ziggy saga. Now let us look at the next document that follows. The next document that follows, it's document C. Document C is coming from the Chief Financial Officer to the newly qualified CSA. A newly qualified CSA in this case was the candidate. And it is about the audit preparation. I'm so glad to have a newly qualified CA on board. Definitely going to make my life a little easier. Just a heads up on 3 issues I will need your assistance with. So the first one, it's about deferred tax. I asked Leonard, our group financial accountant, to prepare the deferred tax calculation as at 30 September 2019. That's the number you would have seen in the draft financial statement for the financial year 2019. In the past, Isa and Associate, our external auditors, assisted with us. However, I think that we can do it ourselves from this year onwards. Leonard is currently on leave, so we can have a discussion about this on Wednesday when he returns. I want you to understand, candidates, that the candidates for 2019 were writing this paper on Wednesday. So that means more information will come on Wednesday when you are writing the paper. Now, this is a trigger, with no doubts. This was a trigger. So now, what you need to understand when you're looking at this, you are told that in the past, this was done by Isa and Associate. So what does that mean when they're saying in the past, this was done by Isa and Associate? It basically means that the work that is done now is most likely not correct, because we are doing it for the first time. And the reason that the deferred tax in the past was done by ISA and Associate is because internally we might be struggling to do the deferred tax for the company. So now, what is the trigger here and what could potentially happen? And that you need to understand before you go and write on Wednesday, because on Wednesday, there will be discussion about this deferred tax calculation that has been done by Leonard. Now, I want you to understand the candidate that on Wednesday, when the candidate wrote in 2019, it most likely what they provided or what they were provided, it was an incorrect deferred tax calculation. So now how the candidate was supposed to prepare themselves for this trigger of a deferred tax. The candidate needed to go and look at the financial statements of APC and ask themselves which numbers in the statement of financial position attract the deferred tax. Once they've looked at which numbers in the statement of financial position attract deferred tax, they need to ask themselves, what is the tax treatment and what is the accounting treatment? They need to know that, or they needed to know that before they go and write the exam. And the reason they needed to know that before they went and wrote the exam, it is based on the fact that if they went and wrote the exam and they don't know what is the tax treatment and accounting treatment of investment property, they were not going to be able to see the error. So in order for you to see the error, you need to first understand how to do the work. So if you don't know what is the accounting treatment of allowance for bad debts, for example, the SAICA, and what is the tax treatment, you will not be able to respond to the paper. And the reason you will not be able to respond, it is based on the background of you wouldn't know what is accounting treatment and what is the tax treatment. And remember, the deferred tax arise as a result of the temporal differences between the accounting treatment as well as the tax treatment. For that reason, that is why you find yourself encountering the differences, because how SARS is treating the allowance or how SARS is treating the depreciation, it's not the same as how accountants are doing it. And that result to the temporal differences. So a candidate or the trigger here was for the candidate to do a simulation of the deferred tax calculation using the statement of financial position of APC before the exam and understand what is the tax treatment as well as what is the accounting treatment of the numbers that attract deferred tax that APC has. So I'll make an example. The candidate first needed to know the how to arrive at temporal differences for the investment property. Because we know investment property, the company has. And then you need to understand around investment property, the fair value adjustment, right? And then when you're looking at the trade and other receivables, you needed to know the allowance in the trade and other receivables, how accounting treat it, and how SARS treat it. And then you understand how to arrive at the deferred tax. Also, we in the statement of financial position, we had other PPE items. So you needed to know all the items that attract the deferred tax, how to treat them. I want you to also understand some items do not have temporal differences. And in the paper, it most likely that the candidates will be provided those items that do not have temporal differences due to error, right? And you needed to identify as a candidate that this is an error. That what is important for candidate to understand about those papers that you are most likely going to be provided an incorrect calculation. And with that calculation, you need to assist the CFO as well as Leonard to correct it. So that basically the trigger that was here. Most likely you would get the calculation that is incorrect. Therefore, you need to do a simulation of the correct deferred tax before you go write the paper. Then number 2 is the sale of a portion of the shareholding in Kasuba LLC. We held an 80% shareholding in Kasuba LLC, a Zambian property company that owns the biggest shopping mall in Lusaka. We sold a quarter of our shares of Nkumbu LLC in August 2019, as the Kusaba property has recently not been performing well. So what are we hearing here? Not currently, because now you're after they make sale. So what happens? They were owning 80% shares, right, in Kusuba LLC, a Zambian property company that owns biggest shopping mall in Lusaka. And then they decided to sell a quarter, right, to Wankumbu LLC in August 2019. So candidates should realize by now that this sale happened just before year end, because the year end of the company is September 2019. And then the reason they are selling it is because the company is not performing well. The sale reduced our shareholding from 80% to 60%. Though the transaction resulted in amendment to the shareholders' agreement regarding our decision-making right, Wankumbu's offer was too good to refuse, and we also welcome the cash injection. So what is important for you to see here? Their shareholding only reduced by 20% because they sold a quarter of 60%. However, there's important thing that they are saying here. They're saying there were changes in decision making right. So what does that mean? There is a potential that they lost shareholding, even though they still own 60%. I'm not saying they have lost it, but I'm saying there is a potential that they have lost it due to the fact that we are told that there are changes in decision making rights. And the offer was too good to refuse. And they wanted it because it gave them the cash injection. And we know that the company's bank statement was going down from 2018 to 2019. And yes, the company really needed money. Right. So now, as you see here, you're like, okay, looking at what I am being provided here, the most important thing that I see, or the most important thing that I can gather from the information that I am given here, is that the shareholding is dropping. And when this shareholding drops, the decision making right will change. So if the decision making rights are changing, what does it mean? It generally means that it might happen that they're losing the shareholding. And the offer being too good, it might mean that Wankumbu is saying, we are going to give you good money, but you're going to lose the control of this company, right? So we're not 100% sure, but those are kind of things that we can gather from the information that the examiner has provided us this far. Then when we move next, we expected swiftly We acted swiftly when the opportunity arose, and we have not had time to consider the accounting. The sale is not reflected in the financial statement, although the transaction was effective prior to 30 September 2019. We have not received the cash as it is sitting in the trust account awaiting Zambian Reserve Bank clearance, which is expected very soon. So now what we can gather from the information that you are provided here, because it is very important, candidate, to look at the information and look at it with understanding. So now we are told that the transaction was completed, but it has not been taken into account in the books of the company, even though the entire transaction was completed before 30 September 2019. And the other information that you are given is that because of clearance, because the money is coming from Zambia, it has to be cleared by Zambian Reserve Bank before it comes to South African Bank. So just the clearance, we are told that it has not been completed yet. Yes, the money has not been received, but all the transaction pertaining to this transaction has been concluded. Now, you are a candidate. As a candidate, what are you supposed to be doing? Now you ask yourself, I have this information, but I do not know what I'm supposed to be doing. I do not know what really is the trigger here. So let's then dive deeper and discuss what is the trigger. So what do you think is a trigger here? So basically, here you needed to do first the qualitative aspect. So you're just using the information that you have and then drafts the qualitative aspects that comes with this transaction. Obviously, you see that the decision making right might mean that now we are not holding the minority interest. So is it good or bad for the company? It's not good for the company. And then the other thing you will see that the company is not performing well by selling portion for the company that is not doing well. It is good for the company. And then the offer that we receive, it is too good. So if something is too good, the company would like to receive it. And then the cash injection will help the company, as we've seen that their cash is currently not doing so well. So meaning to say they need cash. So by this receiving this cash, then it will be good for the company. And we know that because they are saying that they have not received the cash yet. That means the balance of cash that we saw in the financial statement does not include this cash because it's still waiting for the Zambian Reserve Bank clearance. So, which is a good thing for us. We're saying, okay, we saw the drop in cash, but that cash doesn't include this amount because we are still waiting for the clearance. So, since you're still waiting for the clearance, that is a good thing for the company. Okay, cool. Now the other thing is that accounting treatment has not been done, so you need to do the accounting treatment. So it is important for you to understand this is basically mainly that accounting trigger, and you are basically doing IFRS 10. So now what are you going to do? I suggest that the candidates at this point they needed to look at this trigger and say to themselves, there are two things that we need to do. And what are those two things that you basically need to do? The first one that you need to do, we are saying we are losing control after selling 20% of our shareholding in Kasuba LLC. That's the first one. And the second one, we are saying we are not losing control and then work on the accounting treatment for both. First accounting treatment, we are losing control. Second accounting treatment, we are not losing control. So that helps you when you get to the exam and they are saying, because of the decision making right to change, the company has lost control. Right? Or they're saying, no, actually, we did not lose control, even though there were changes in decision making, but we did not lose control, right? And you are able to interpret the accounting numbers. And it's most likely in the question like this, you are not going to be asked to make calculation because you have limited time. You will be provided the calculation, but that calculation will most likely be incorrect. However, if you have prepared yourself for this type of question, you are going to be able to work on the calculation, even you were to be asked to do the calculations. So now that takes us to the last part of 2, then we're going to look at 3. 3 is the preparation of files for upcoming 2019 external audit. So now what do we see here? As in the previous years, my team and I will prepare the files of evidence to support the amounts and the disclosure in the 2019 annual financial statements. Based on the evidence that we received from the ESA and Associate Audit Manager last year, we want to use the risk of material misstatements as a point of departure for preparing these files. The higher the risk of material misstatements, the more comprehensive our documentation will need to be. Our internal auditors are currently in the process of undertaking this risk assessment exercise, and once completed, I will forward this to you to make a review and input. So what you see here, this is an auditing trigger. You cannot go to the auditing trigger without understanding the risk of material misstatements. All right. And when I'm saying the risk of material misstatement, we're talking about the risk of material misstatement at the assertion level as well as at an overall level. And the reason you are doing that is because they only said the risk of material misstatements in preparing these files, right? So what will happen? First, let's just look at the risk of material misstatement of this company weighs high, and we're looking at the point of assertion level. The risk of material misstatement at assertion level, I can tell you straight away from now, it is high on the investment property. And why? Because there are fair value adjustments. And the fair value adjustment is based on assumptions. The third party might be working on those values. And when they work on those values. What does it mean? It basically means that the assumption used might not be correct. They might not have expertise to work on the valuation, the number of things surrounding the investment property. The other area or other accounts balance that I might think it has the higher risk of material misstatements, it will be balances like your revenue, a balance like your trade receivables, as well as the transaction, the revenue. So why am I saying that? When you're looking at the revenue, it has obviously the cash component as well as the credit components. So when you're looking at the credit components, it might happen that whatever that you have put through and said it's our revenue, it's not actual revenue. And the reason for that, it might be the number of cases, could be an error that is happening when we are recording the revenue, because we have number of areas that we are collecting revenue from. And number two, when it comes to revenue, we are told that the third party that we are using, it's already making errors in the corrections and the books. So by hearing that, now you're sitting down and say the revenue is most likely to have the high risk of material misstatements because we are using the third party and we have number of clients, So there could be error happening in the revenue. And when you're looking at the trade receivables, the error that you could think there is because you need to adjust for the allowances. So the adjustment used might not be correct because of the management assumptions that might not be correct. So those three parts, I think at assertion level, there is like higher risk in terms of those transactions, which is revenue, and the balance, which is trade receivables, as well as the balances of investment property. And I've already explained what am I taking point on that one. And then when we're looking at overall risk at an overall level, so we have been told that the company is pretty much not doing well. And the reason it's not doing well is because of the economic outlook and the fact that there is a high unemployment, which obviously affects the business in terms of collecting revenue. So then you need to make an assessment of everything that affects the risk for these accounts that I've already stated and the accounts that you might think they are posing the risk for the company. And then what else you're going to do, and you'll look at overall level. So the information that you have been presented to you in the background is sufficient enough for you to be able to understand the areas that has a risk of material misstatements, either at assertion level or even at overall level, based on the information you've already been given in the background. That is why, candidates, it is very, very important that you read the background information with and proper understanding. If you don't have a proper understanding, you will struggle, unfortunately. So it is very, very important that whatever you read, you are reading with a proper understanding. Spend more time falling in love with the pre-release information rather than you deciding to spend more time looking at the information of the other companies or other competitors. I will emphasize over and over again, understanding the pre-release information in and out. It is very, very crucial for you to pass that exam. Do not spend time looking at the competitors. What are the competitors doing? Reading the entire integrated report. 5 days is designated for you to know the pre-release, fall in love with the pre-release, and understand all your triggers. So that is very, very important to understand. Now we are done with the C, then we'll move to document D. So what is in document D, candidate? Now let's just dive into document D. So document D is coming from the Chief Executive Officer. It is important to identify now it's coming from the CEO, not the CFO. And this was sent to the candidate, the newly qualified CSA. And it's about the valuation. Now let's just see what we have here. The CEO is saying, hi there. You may have heard that certain property groups such as Reposes has been selling off properties to reduce their gearing levels. As stated in section 12 of the PowerPoint presentation I sent to you on your first day at ICOS, we are on the prowl for juicy acquisition at attractive yields. My father always said that valuing properties should be simple. Just divide the current net rental income by the cap rate, and that's what you should pay. ICOS has historically used a cap rate of 9% when evaluating potential property acquisition. I would appreciate if I would appreciate it if you could do some research on the cap rates that are currently being used by retail property group and what would be an appropriate rate for us to use. So now what do you see here? The CEO is coming to you and saying they want to do an acquisition, right? And you know that every year they make acquisition of 111 property. But now they're telling you that they want to do an acquisition. And they're saying in order for them to identify how much they should pay, the CEO is telling you that her father once said, in order to identify that, you need to say current net rental income by the cap rate. And they're saying the cap rate, they normally use 9%. That is for them to evaluate the potential property acquisition. So now the CEO is telling you, there is an acquisition they want to make. And in order for them to ascertain how much they should pay, they are going to say, what is the current net rental? And they divide it by 9%, which is the cap rate. So now he's making a request to you, he's saying, I would appreciate it if you could do some research on the cap rates that are currently being used by the retail property group and what would be the appropriate rate to use for us or for us to use. So this is a trigger. You cannot go to the exam without ascertaining what the CEO has asked you. First, you need to ascertain, is it correct to determine how much to pay using the current net rental divided by 9% or divided by cap rate. And then you are told that you need to go and make an assessment of whether of the current cap rates that is used by the retail property group. And when we go down further, also, when we receive the revenue and expense figures, including future projections relating to those properties from our vendor, how do we go about verifying the integrity of what is reported to us? Can we rely on the vendor's auditors for this purpose? If not, can we do this verification ourselves? Or should we appoint an expert to help? So now you see, now you know that we have third party that is working on the collection and reporting of the rental income. It is not done internally by us. It is done by third party. And the third party will give us the revenue and expense figures. Now the CEO is asking to you, how do we rely on those numbers? How do we know those numbers are correct? How do we verify the integrity and accuracy of the numbers, as well as the completeness of these numbers provided to us? Can we use their auditors? That means the third-party auditors. Can we verify ourselves whether they're correct or not? Or rather, should we appoint an expert? Now, what do you need to do in this? The first part, you'll be assessing the cap rate and whether it is correct to use the cap rate, and also what cap rate is being used in the retail property industry. Here, what you know is that you will be provided the numbers. And those numbers, they might not be right. Chances are high. And when they are not right, put down, if the auditors is used, what is good thing and what is bad thing? If we use expert, what is good thing and what is bad thing? If we decide to verify the integrity of the numbers ourselves, what are good things and what are bad things? So that is very important for you to understand. You need to do that. It is very crucial for you to do it, right? Now that you are done doing that, you go and look at the valuation, any valuation of the company that you can get online. And then say, I'm given the valuation on the day of the exam to evaluate the correctness. What are the things that I need to think of? You need to think of things like the inflation. you need to think of escalation clause they have. You need to ask yourself the numbers that might be missed, the numbers that should have not been included in the valuation calculation. So you need to know that before the paper. Remind yourself about the valuation inputs. What should be there, what should not be there, how to calculate it, all the numbers that are there, how to calculate, how to determine them. Right. So you need to make sure you prepare yourself for the valuation before you go to the exam. So this question, it's mainly about the valuation, which is the financial management in your management accounting course. So make sure that you understand that before you go to the paper. So that, or rather, the candidate was expected that they know that before they go to the paper. Now, just to summarize overall what the candidate was expected here, number one, they needed to work on the cap rate and whether it is correct to work on how much to pay by dividing the net rental with income. And the second part, they are expected to understand how to calculate the valuation because it's most likely that in the exam, they were going to be provided the valuation that is incorrect and they were needed to make sure that it is correct by obviously writing down and responding to the CO, this was not done correct and why it's not. This is was not done correct and why it's not. So you can only do evaluation of the work performed by other people by you knowing how to do it. So you need to make sure before the exam, you know how to work on the valuation of the property. Now we move to the next one, which is document E. Document E, it was coming from the CFO to the newly qualified CSA. So it was coming from the CFO to the candidate, and it is about the Hope for Children Trust. And now let's just read together and see what is presented to us. A further request, I would like you to become a trustee of the Hope for Children Trust, HFC Trust, as I think that it is really important that someone with a strong financial and governance background serve on the board of trustees. On the board of trustees. Then when you move down, they're saying the HFC Trust has the potential to do the great things, but it is constrained due to the cash flow situation. This stems from HFC Trust acquiring its shares in APC from the Njegi Family Trust a few years ago, with the acquisition being funded by means of an interest-bearing loan. However, as APC has not been paying any dividends in recent years, the trust have had to take out bank loans secure against investment in APC to fund bursaries for disadvantaged schools going children. So now what do you see here? The number of things that you see here and you need to think of. Before we move to the next paragraph, I want you to look at the information that is provided by the CFO to you. So CFO is saying they want you to become the trustee. The question, do you have capacity of becoming a trustee? And are you able to become a trustee? And then the reason he wants that is because of your strong financial and governance background. The question is, are the people that are currently serving on the trustee not having the strong financial and governance background? So you're asking yourself those questions, right? Because this looks like an ethics question. So you need to ask yourself certain questions to be able to understand what is going on. And then we move down to saying, this trust has a potential of doing well. However, they have a problem because they acquired shares in APC a few years ago, and then they funded through interest-bearing loan. Now, when you look at this, was it a good idea for the business to acquire shares or for the trust to acquire shares using the interest-bearing loan, right? And then further to that, you are told that APC is not paying the dividends in recent years. So if APC is not paying dividends in recent years, what does that mean? Most likely that the company is not doing well or not doing as they expect to be doing, right? And then trustees have had to take out loans to fund the bursaries. So what is happening now? The bursaries are now funded by loan. Is this a good idea for the companies to fund bursaries by loan? Should they not be using the excess money available to fund these bursaries? So this is the kind of question that you are popping to yourself and saying, you don't think that is correct for funding these bursaries to disadvantaged schools using the loan, because this loan will attract interest. Now they are funding the disadvantaged school, which is good. However, the way of funding doesn't look good, because now they're not using the excess funds available to the company. However, they are now using the loan. Then when you move down, also, the record keeping at the HFC Trust is rather poor. It is handled by Rolihla Njeke, Freeman's brother, who is also responsible for the trust day-to-day operation. I think that you should push for the record keeping to be done by AUKUS Finance and Administration team, even if it is done on a pro bono basis. This would be the right thing to do, especially in view of the prominence given to the good work done by the HFC Trust in the marketing potential of AUKUS, and which enables AUKUS to demonstrate its good corporate citizenship. So now what do we see here is that currently the finance of the company, of the trust, is done by Rolihla Njeke, right? And now the CFO is saying he doesn't think that everything is done properly. So now he's saying, let us do this record keeping by the finance and administrative team, and then this would be on a pro bono basis. So now this is a bit concerning that the finance and administration team of AUKUS will do this work on a pro bono basis. So is it correct to be doing work on a pro bono basis? It's more like you're not going to be getting money for doing the work, but you'll have to do it. So it's kind of a bit of concerning in terms of how will the CFO think that it is correct for this work to be done on a pro bono basis. And then he's saying this would be the right thing to do, especially in view of the prominence given to the good work done by the trust in marketing material of AUKUS, and which enables AUKUS to demonstrate good corporate citizenship. So now you see that they are still pushing on giving the bursaries for the companies, even though the trust is using the loan, because they are using to appear as good corporate citizenship. Is it a good thing to do it that way? And also, they are saying they are using these bursaries as a marketing material for AUKUS, right? They are doing it obviously to appear as good as they in the public. So now you ask yourself, is this good? Does it appear right? To me, it doesn't appear correct. But hey, this is what you are provided. Now let's just look further. I also know that some work is acquired to improve the HFC Trust governance team, which is especially important given that the Board of Trustees is keen to raise funds from the donors, including the tenants of the AUKUS owned properties. Freeman Jege is the chair of the Board of Trustees, and if you agree, I would like to forward you the name to him to initiate process of obtaining the requisite approvals for your appointment. While there is much work to do, this will be where you will play a part in giving back to those who are less fortunate. So yeah, the CFO is giving you the opportunity. You just joined the company. You don't know much about the company, but already you are being told that there is a need of your expertise in the trust, right? So now you haven't even circled so well in the organization. However, now the CFO is saying, hey there, here's something that I think might best suit you, and you would be doing it on a pro bono basis. So this is definitely an ethics question, and the candidate was expected to dive deeper and see everything that I've highlighted, whether it's good or not. So now this takes us to the end of this paper. Now, what we're going to be doing next, the next part will be our focus, and the focus that we'll have on the next part will basically be us sitting down and looking at the information of the day and whether we have covered everything during our reading of pre-release information. And I want you to see, as we go through the information of the day, that it was indeed not important for the candidate to know much about the competitors based on the information that is presented to us. Thank you so much, candidates, for listening up until this far. I wish you all the best in your APC studies as you prepare for your final exam that you'll be writing at the end of this year. And please follow me for more videos of similar nature. And goodbye.